You've defined the neckline such that you get through that neckline on momentum now. I'm talking weekly momentum plotted in daily bar format. Next week, somewhere about, like I said, a buck above where you are now, we're just below 29. You get in the upper 29s estimated. You're going to blow that head and shoulder neckline out, and you're going to restart silver. So we think we're close to the end of the congestive pullback, and we'll resume the acceleration phase. What is likely to help spark that resumption? Watch the stock market.
As we reach the midpoint of 2024, renowned financial analyst Michael Oliver predicts a dynamic shift in the precious metals market. Oliver, known for his expertise in momentum structural analysis, foresees a strong upward trend for gold and silver. This comes amid rising concerns about the stability of the stock market, which he believes is on the verge of a significant downturn. His insights suggest that the current economic environment presents a prime opportunity for investors to consider adding these metals to their portfolios. Oliver criticizes the Federal Reserve's monetary policies, which he argues have inflated a stock market bubble. He anticipates that this bubble will burst in the third quarter of this year, leading to a sharp decline in stock prices. Such a downturn, according to Oliver, would likely prompt the Fed to implement emergency rate cuts. This response could create a favorable environment for gold and silver as investors seek safe havens amid market instability. Focusing on the technical aspects of the market, Oliver highlights the narrow leadership within the stock market, driven by a handful of sectors and stocks. He points out that sectors such as commercial real estate and consumer discretionary are showing signs of weakness, which could signal broader market vulnerabilities. These indicators, combined with his analysis of momentum trends, support his forecast of an impending market correction. Now, we'll show you the best clips of the latest interview, but first smash the subscribe button, smash the like button, and don't skip any parts of the video. Enjoy the episode.
First off, in our assessment, the gold bull, we're flexible on gold long term. We primarily look at long-term trends, sometimes intermediate. But we got bearish on gold, for example, in 2012. So, we're fair and balanced, okay? After it peaked at 11, 3 months later, we said, that's it. It never could get back to its high again. It just labored in 2012 and finally crashed in 13. Then in, in February of 2016, coming up off of its low at 1,050, actually 1,046, at $1,140 in February of 2016, annual momentum said, green light again. Bull trend has begun. Okay, nothing on annual momentum has argued since then that trend is over. It's been ongoing. Despite the 3.5 years that gold spent capped off at just above 2,000, and silver in downward staircase and miners in a downward corrective staircase. For 3.5 years, that pause did not break the dynamic of the annual momentum positive trend for gold. It just paused it. Okay. The action in March in gold coming up through the price highs, actually. The price was fairly coincidental then. Annual momentum of gold broke out through a secondary structure, saying, okay, the doldrums are over. We're back into a resumed strong mode. One that should be more dynamic, because at the end of prior bull markets, there have been a couple in the last 50 years, where gold's gone up 8-10-fold in a matter of 10 years. Mid-1970s to 1980, 2000 to 2011. Okay. Well, if we went up the same dimensions that we went up back then, gold would be $8,000, $9,000. An 8-fold move. I mean, those moves are 8 and 10-fold moves. Okay. But usually most of that move occurs in the last year of the bull trend. Most of the dynamics occurs then, where it suddenly unleashes. And right now we argue you've got the fundamental and technical background that gold has never had before, the dynamics of which should drive it, should explain why that kind of dynamics will unfold. Yes, we've paused. Okay, now gold made a high in April, above 2,400. Gold made a high in May, above 2,400. Gold's high this month, just above 2,400. So you had 3 months in a row up there with highs within 1% or so of each other. Hardly a dynamic top. You know what I mean? A spike top. Like in summer 2020, when you hit your high, you dropped. 2011, when you hit your high, you dropped. You didn't come back to it again. Okay. So we're getting a really a lateral movement in gold. Right now, is we do the interview goals like 2310. Okay, so it's 3-4% off. It's the 2400 level. It's just a sideways, boring looking thing. Silver, meanwhile, did something different. Now, right now, it looks like silver's had a deeper pullback than gold. Yeah, over the last 4 or 5 weeks, it has since the May high. But silver in May vastly took out its April high, unlike gold, which plateaued. Okay, silver went on further. We suspect, based on shorter term momentum trend dynamics, that this pullback you're getting right now in silver, and as we're speaking, it's down under 29. Okay, it was under 29 a week or so ago as well. We think you're probably very near the low, if not at the low, and it won't take like a $1 upturn from current price levels to really explode it up out of the hole again. You don't have to go back to 32 and a half to make the point. You get up around the upper 29s next week, you're going to resurge. It's going to resurge again. So we've got some charts that show that point there. But when you look at like the daily action of gold since let's say April or May, you see this sort of sideways on momentum. You see a very clear multi-point downtrend structure, something that if you break out above is a buy signal. You can't find that line on the price charts. Price charts are sloppy. So the price charts leave you confused. You know, where is it resuming? You know, momentum says, you know, about next week, probably about $40 above where you're trading right now, you're going to break out again, resume. Okay. Silver has a similar pattern, except this has a downtrend line. It's fairly steep. It already broke out above it, but it's developed what looks like, if you look at the momentum chart, not the price chart, you'll see what most chartists would say, oh, that's a head and shoulder bottom.
In today's news recap, alarm and amusement at Biden's performance as world reacts to debate with Trump. Thursday night's presidential debate was watched around the world by allies anxious about their future U.S. ties, as well as autocratic governments seeking to rival the U.S.-led global order. The two candidates have distinctly different ideas about how to tackle the challenges of a world consumed by multiple wars, rising geopolitical tensions, and doubts over America's commitment to its longtime partners. That contrast was occasionally on show Thursday night, but it was Biden's performance that dominated headlines. Personal attacks, hazy memory, mocking each other. This debate was very entertaining for many Chinese people, Hu Xijin, a nationalist Chinese commentator, said in a post on X. The prospect of Trump returning to the White House is alarming for many U.S. allies in Europe, Asia, and elsewhere, their ties with Washington having often been strained during his presidency. Biden's debate performance is prompting British diplomats to prepare more urgently for the prospect of dealing with Trump again in the White House, the former official said. Now we'll show you the best clips, but first smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our daily recaps. Enjoy the show.
Well, a lot of analysts know this, and it's bleeding obvious that the market's very narrow, stock market. It's narrower than it's ever been in terms of what's leading the market. And, you know, it's a handful of stocks and one sector out of a dozen that's really doing it. If you look at certain sectors of the stock market, like banking, one we're particularly interested in is commercial real estate or REITs, ETFs like RWR, VNQ, which don't show the housing market. They show more commercial real estate. That's lame. It's in the middle of its range in the last 3 or 4 years, not anywhere near its high. And there's some other sectors as well. One in particular, consumer discretionary. That used to be a hot leading sector from 2009 through 2022. It led the market. In fact, it outperformed the S&P. You wanted to be long that. Well, you know, at the front end of that ETF, for example, is Amazon. 24% of the entire ETF is Amazon. So you got one of your big fat leaders in the front of that ETF. And yet that ETF, when you look at a chart of that XLY and compare it to like a monthly chart of the S&P, they're in different universes. XLY is not near its high. It looks very anemic. In fact, even with Amazon's leadership, it still looks anemic. Something's wrong there. Normally, XLY is considered a risk-on sector, meaning it's the one you want to be in when you're going up, okay? You take the risk, make the money, okay? And consumer staples, which is opposite to consumer discretionary. That's the day-to-day stuff that consumers have to buy. But consumer discretionary reflects the exuberance of the consumer. Well, how come XLY looks so bad, even on a price chart? Well, so we're watching certain segments of the market, not just the market itself, like the S&P or the NASDAQ 100, for signs of momentum trend breakage. Now, what do we mean by that? There's a lot of momentum indicators out there on your computer screen. RSI, MACD, you push the button, it's free, it's part of your program, They're what we call wet noodle indicators. In fact, they look like noodles, okay. Mm-hmm. Sometimes they're reasonably good, sometimes they're very lagged, sometimes they're meaningless, particularly in a dynamic market where you think you're overbought and they ram it to you for another 4 weeks of overbought.
Yeah.
Okay.
Yeah.
In a normal trading market, they might be okay. But in this environment we're starting to get into, I think referring to that stuff won't work. What we look at are momentum structures. Just like you look at a price chart, you draw a line under multiple lows that are ascending, uptrend line, or a flat floor. That's a structure, okay? We do the same thing with momentum oscillators, which often do not look like the price chart. And so it was the case, for example, and I'm not going to argue we're going to crash in the third quarter. I'm just going to argue there's probably a sharp initial downside in the market. But back then, if you looked at the price action in 1929, August, September, even into early October, and the same thing at 87, and in fact, I caught that one. That's one of the reasons I developed momentum structural analysis. The 87 crash looked absolutely copacetic prior to the crash. As you looked at the price chart and thought, oh, it's just a little pullback, no big deal. When you looked at momentum, you were breaking the bridge over the River Kwai. I mean, you were blowing the structure out. But on price, just a little dip. And you suddenly went from a little dip to a 35% crash within a week and a half in late October. And momentum explained it, price didn't. We have similar structures right now set in most of the indices and sectors of the stock market, such that when you go back like to the last pivotal price low, which was in October of 2022, that's when the 22 sell-off ended, was in October. You turned up since then. So what are we talking? 1 year and 3/4 of upside, okay? The S&P's made new highs. NASDAQ 100's made new highs. Some sectors have, many sectors haven't. But you've got a momentum structure that's been built during that time. Not just the price action that you can't define it very well with a good trend line. It's sort of curved. In other words, you can't find a multi-point trend line in most cases on the price charts. But on momentum, you can see a structure that a blind man could feel. Okay, it's just perfectly clear, in-your-face structure. The problem is when we get into next quarter, those structures are vulnerable for breakage because the numbers underlying the momentum structure, meaning like the 3/4 moving average, is going to move up. Hence, the relationship between current price and the 3/4 average is going to narrow because the mean by which you're measuring is jumping up. And the problem is you can't narrow it much because you're going to break these structures.
What do you think of Michael Oliver's opinion? Will the global markets collapse overnight, or will just everything be fine? Post in the comments section down below your honest opinion and share your gold and silver price prediction for the end of 2024. Thanks for watching till the end. Now check this video right here because it's a perfect fit for you.